when I go to choose investments, what is it that I look for? A lot of it's very basic. Now, I'm going to give you 5 things that I have as a criteria for myself. It may be different for everyone. This is just me. And if you're an experienced investor, maybe you pick up a couple different things that you're not doing. Maybe you can comment below and give me some ideas on what to add on top of my criteria that can help determine what a great investment is as well. I would love to hear the feedback. The first one, fundamentals, fundamentals, fundamental. There's a reason why the definition of fundamental is an essential part of something. Essential. You can make very informed decisions when you look at the financial history of a company. Let's take Apple, for example. Here's what I like to see. I like very good profit margins, positive profit margins. That is not the end all be all because there's a lot of new upcoming businesses that offer even more growth opportunity than established businesses that would have negative margins, right? They're just getting started. That's understandable. This is just my criteria and what I like to see. Positive profit margins. Apple's is like 25 to 30%. Then you take that and you compare it to what is relative to that sector that that company is in. So what is Apple's compared to Microsoft's and other companies like Apple? The margins are higher. They have a competitive advantage usually in that sector because they are able to do the same business at a lower cost and make more money with it. Next is your ratios. When I say your ratios, I'm talking about your current ratio, which is your current assets divided by current liabilities, which basically on a balance sheet, which is just a snapshot in time. It's not set in stone. It tells me if the current ratio is above 1, then they have more current assets and liquid assets than they do liabilities that could be needed to pay off in the short term. So they're solvent. I then go to look at, well, how much debt total does a company have? And are they incurring new debt? And if they are incurring new debt, are they doing it at a faster rate than they normally do? And if they are incurring it at a faster rate than they normally do, why are they doing that? Apple has a total of $132 billion in debt. But they have an operating cash flow of $122 billion and then a levered free cash flow of $90 billion. So they have a substantial amount of cash available, which means that they don't have to either incur new debt or they don't have to do a share offering to raise funds for any investment projects, which means that they're not going to dilute any shares. Again, that's not too big of a deal. I'd rather them do a share offering and raise money through the shareholders than I would with them incurring debt because debt has to be paid back with interest. Well, you say, well, the shares have to be paid back with dividends, but the company doesn't have to pay dividends if they don't want to. So the debt they have, $132 billion, they have more debt than they do assets and cash to pay the debt, but it's not too bad. Then I look at revenue growth. Why revenue growth? I want consistent revenue growth because if I just right off the back, if they have consistent revenue growth every year, every quarter, then chances are they're growing that business. You really need to take those few things on the financial sheets and put them together. And that's how I determine a picture of, are they running a good business? Number 2 is, what is the future of this business? Will Apple still be selling iPhones 20 years from now? Maybe. In the foreseeable future, yes. They're very innovative. They have remained innovative. They are the market leader by far. And it's really hard to compete with them. There's things that can happen regulatory-wise that kind of make it more competitive on Apple's behalf. But for the foreseeable future, Apple is larger market cap-wise than most economies in the world. As long as they continue to do what they're doing, Apple will be around. How about John Deere? John Deere is an investment I absolutely love. John Deere has awesome fundamentals, great business model, and they have been around since the beginning of tractors. Farming is always going to be a necessity. Then John Deere makes the best tractors. So for the foreseeable future, John Deere will always have people to sell those tractors to. What about Ford? Ford's another one. GM, there's a lot of competition in the auto industry, but cars will be in demand for the foreseeable future. And when cars are not in demand, it is because they are making something else that probably flies at that point. And they'll probably be making that stuff. So these are businesses that will continue to at least have an industry to participate in. Then you have to consider, okay, the competition in that industry. Who's competing with these businesses? Renewable energy, at the moment, highly competitive. However, Enphase Energy is one that has done very well. And if you're going to invest in highly competitive industries, which is a good thing if they are competitive, you need to find which business in that industry has the competitive advantage. The third point that you need to take into consideration is government regulation. This goes to what they call political risk. Great examples, we had the infrastructure deal and the Build Back Better plan passed last year. They are pushing this climate change narrative. Well, who benefits from the climate change narrative and who doesn't benefit? Okay. Enphase Energy, while in this bear market, is hitting all-time highs. Why? Well, the government in the United States gives out contracts to private businesses. Companies in the renewable energy or climate change, whether you agree with it or not, and look at it from a money-making perspective. It's an investment. You're there to grow the value of your money. I may not think climate change is all that big of an issue, but I don't care. The government's going to throw a bunch of money at these companies. I'm going to invest in them because their businesses are going to grow. And Phase Energy is a great example of this. Oil companies is one that has benefited this past year because demand for oil is still high. But what does the future outlook for oil look like? Would you buy shares of an oil company right now? I don't think I would. It's at all-time high. Could oil prices go up? Yes. Will the demand for oil still be there in the foreseeable future? Yes. However, it's going to diminish. Why? Not because the consumer wants it to, but because the governments definitely want it to. And they're going to do things to disincentivize oil companies to keep producing oil. They're going to make it hard for an oil company to be profitable. They're already meeting today to see if they can set global price controls on Russian oil at around $60 a barrel. If you do that, that diminishes the amount of money that these oil companies can make. Again, we're not looking at this from buying it at the pump. We're looking at this from an investor standpoint. And am I going to get that 3 to 4% dividend on my $100 share? Or am I going to get that 3 to 4% dividend on my $50 share in the future when the prices decline? So these are things to consider. Taxation is another thing with government regulation that can limit the profitability of a business and the future outlook on it. Here's what you got to remember. It's like 30 to 40% of negative factors like tax increases on a corporation pass down to the consumer and to the employees, either through higher prices or layoffs. Businesses have investors and they need to maintain their margins. The idea that trickle-down economics doesn't work is kind of a flawed idea because maybe it doesn't work on the passing all the benefits that corporations get down to the employees, but it does 100% work when it comes to passing down tax hikes. The bad things the government does on corporations trickles down 100%, and trickle-down economics is extremely feasible in that matter. Number 4. Now, this one's a new one. This is one that not everyone's going to agree with. This is something I don't even agree with. This woke culture we have, unfortunately, is a reality of our society now. So when companies are doing things that are unfavorable to what society deems, like saying things that may be against the LGBTQ community, what kind of impact could that have on a business in a negative sense? Or if a company comes out and supports some kind of woke culture, will people stop doing business with that company? Look at Twitter. Twitter is a prime example of this. If a company is going to deplatform people because they don't agree with what they're saying, well, they're deplatforming users. If you're an investor, the last thing you want to see is for them to deplatform users of the company because they disagree with their political opinions. And you may not agree with this, but hear me out. These companies earn money from ad revenue. Other corporations, other business owners will come to Facebook, they will come to YouTube, or Google is YouTube, and Twitter, and they will pay to advertise on the platform. For them to get a benefit and be willing to pay, there has to be users of the platform that are seeing the advertisements. Why am I going to go to Twitter and pay $50 to run an ad for a week on a product I'm selling if no one is going to see the ad and I'm not going to get any new buyers of my product? So if they are deplatforming people based off of political opinion or based off anything really, then that is less advertising revenue for the business and a substantial risk to the business. The last thing you want is investing in a social media platform that is deplatforming anybody. Again, people may think, "Oh, you're crazy." No, I'm being honest with you. Now, number 5, and this is the most important one. You can do as much due diligence into businesses as you want. You can pick the best stock investments. It's not worth a shit if you're not doing your due diligence on yourself. You need to know yourself. You need to know what kind of investor you are. Are you an emotional investor? Are you risk adverse? You need to know, how much money am I willing to lose? What is my need for this money? If you're about to have a kid and you have $10,000 in the bank and you're going to go throw it on some meme stock, probably not a smart idea, right? But if you are young and you have some money and you're working, you have a stable income, and you're like, yeah, I want to grow this money. I have a long time horizon and I can be more risky. And if I lose it, I'll just make the money back after my job. That's fine. These are the things you need to weigh in your personal life. And then you need to sit down. Okay, if the stock goes down 50%, how will that make me feel? Well, I'll probably end up selling it. You never lose money and you never make money until you sell. That's why you have unrealized gains and realized gains. That's why taxing unrealized gains is the stupidest thing in the world, because they don't exist. It's all fugazi, right? Like they say in Wolf of Wall Street. It's not real. It's not real until you sell. So as long as it is sitting in the form of the shares on the exchange in your account, the values that you see increase or decrease only means something when you close out that position and turn it back into cash. So if you're selling it and you're selling for a loss, you have now realized those losses. And then just finish this off, just dive into it. Paper trading is not the same as trading with your own money. You don't get the same emotional experience, and you don't learn the same. Everyone wants to go and do the paper trading. Oh, I made $1 million paper trading. Great. You will not do that with your own money, because you're going to make different decisions. So if you like this video, hit like, hit subscribe, and we'll see you next week.